P2P-Picks is a third-party credit solution, credit risk analysis solution. We offer, what I'm going to talk about today, we offer a number of products, but what I want to focus on today is a white label credit model product demo that we offer for kind of our target audience is either high net worth individual, small to medium size institutional funds, or even regional or kind of mid-sized community banks. Here's our core principle of our core operating principle. Basically, it's that the originator has no real, they don't bear the risk of default. So all the platforms out there, their incentive is to maximize their originations, whereas the investor's incentive is to maximize their returns or preserve their capital. So there's this inherent kind of discord there, and it's neither good nor bad, it just is. And the point is here is that there's a value added to an independent third-party credit modeler who is going to be monitoring that situation, looking at all the originations that are coming out or all the applications that are coming out and kind of buffering that risk to the investor. What is P2P-Picks? We've been in business about 2 years. We've got extensive statistical modeling expertise across the platforms, across a lot of industries actually. We have some consumer and institutional clients. On our website, you can visit it later. We've got 500 individuals registered on our website that's integrated with automatic order execution. We don't provide the execution services, but we just provide the picks, and we outsource that to order management systems. We've got one nationally chartered bank. Yesterday, Renaud talked about the 2 community banks that came on last summer, and we actually manage one of the accounts, completely end-to-end process for them. And we've got one registered investment advisory firm that we signed a couple weeks ago. So we've got some demonstrated alpha and reduced risk. And today I want to talk a little bit about institutional product design that we've created. The focus here is that in our conversations with clients, potential clients, we heard a number of themes over and over again, so we thought we'd develop a product that kind of targeted those ideas. Basically, people want a white label loan selection model. They want to be able to do their own branding. They don't want me in the mix, that's fine, totally get it. And they want it to be unique to them and their needs. They want to be able to host it anywhere they want. They want to be able to select their own order management system, like one of the Orchard, Nodex, or PeerTrader, or Nickel Steamroller. Or maybe they've got their own IT staff and they feel comfortable doing that and they just want to do it themselves. But they basically want to have the model. They want supremely fast execution or operation of the model, of the scoring. They want it to be compatible with any platform in the world. And they also want their model to be secure. So what we do is we've created a product that gives all of those or fulfills all of those needs. The LendGuardian software that we've created is basically a credit model in a box. It's a single executable file written in assembler. And it takes application data from any of the platforms. It takes an encrypted model file that's tailored to your needs, and then some selectivity parameters that sort of shape the model, and I'll get into that in a second, and puts those into this executable, and out pops which loan IDs that you need to purchase. Here's the responsibilities of how we work with our clients. The clients go, they've got to define what their risk tolerance is and what their reward desire is. They've got to kind of tell us a little bit about their capital deployment strategy, how much per month, over what period of time. And then from that, we'll build them a credit model. We'll listen very carefully. We'll parameterize that model so it meets their needs and their goals and their schedules. And then we'll be able to tell you from that, hey, here's kind of what the portfolio characteristics are going to look like based on kind of what volume looks like in the past. We'll update that model every quarter so that things are kind of, as new information comes in, we're kind of tweaking things to make sure it's still performing as expected. It's your responsibility to brand that model. You implement that model with any order management system that you like. You either own, you can do your own or you can outsource that. But as things change, as volume changes on LendingClub, as your needs change, you have 1 month you need to onboard $10 million of cap, you say, Bryce, open up the pipe a little bit so we can get this money going. I'll be able to shift things in that software so that you can easily do that. Basically, this is just a little graphic, kind of a money chart here that shows how it all works. It kind of starts with a credit model. So I picked a LendingClub example here. This set of loans, I think 36-month loans originated last January. Every little dot on there is a loan. And what we do is our methodology rescores everything. We just completely ignore LendingClub's credit modeling. We completely ignore Prosper's credit modeling. That's the whole point, is you want a third party that's redoing this analysis. And so we're plotting these according to the probability of default that we've estimated based on our methodology, and then an expected return on the vertical axis. And so you can see there actually there's a little bit of tilt in these color bands, meaning that actually not all A loans are really equal. And so there's actually a little bit of arbitrage opportunity right now continuing in the market to reduce your risk and increase your reward a bit. And what we do is we take that black line and we'll think about where to tilt this black line for your strategy. So basically, if you want an aggressive strategy, it might look like that. If you're a bank, you might want to shift this line a little bit more vertical towards the A's and the B's to kind of keep your risk curve really, really low. Here's an example of the tool. It's not very sexy. It's just a command line tool. But basically, you pipe in here in the Guardian program the standard browse notes file that you would download from LendingClub, an encrypted model file, and a couple of parameters, and out pop the loan IDs. This processed about 36,000 loans a second, and it was done on a 2011 laptop. So I'm pretty sure you're going to have a little faster Xeon processor there with your order management system. Basically, it should just be able to process an application in a few microseconds. There's a Prosper example to demonstrate that this is platform independent. There's the listings that come from Prosper, as well as a separate Prosper model and a couple different parameters, and out pop a couple of loans within about 14 milliseconds. Any questions? Yes, sir? Will be so perfect that there won't be any alpha or beta. Yeah, so the question that the gentleman has is that at some point there's probably not going to be an arbitrage opportunity. That may be the case. There's still a role to play for third-party independent credit modeling because we want to make sure, I mean, there's a value add in making sure that the credit quality just doesn't suddenly degrade on a platform. So we'd be able to detect that in real time and say, whoa, we just didn't pick anything. Sorry, let's analyze that and figure out what's going on. Oh, check it out. The average FICO score went down to like 300 or something. So even if there's no arbitrage, there's still a value in third-party credit modeling. We want to avoid like a mortgage-backed securities in this market. But I think legally that there's some places that they can't go, but that investors can, and so that there will always be a little arbitrage. Other questions? There's probably some things in the application process that people disclose via their word choice that they really aren't going to be dealing with grammar or something like this on their loan application, but that we might be able to pick up.
Thanks, Bryce.
Yep, you're welcome.
Thanks, Bryce.